Fed funds futures are also backing up what Steve is telling us, and that is the expectations for a hike, basically non-existent this year. The expectations are for a cut. Where do you stand, and what role do tariffs, in your view, have on your growth expectations?
Yeah, I think when we look at it, you're right. The next move that the market's pricing in is a cut and not a hike. I think it's completely off the table. I think what we're watching is certainly the outlook and the guidance, both on the economic data as well as what the dot plots look like and how that continues to evolve. We've certainly been going through an earnings season. Earnings weren't as strong as they were in 2018, but we're still fairly resilient. And what we're seeing on the corporate side is certainly some uncertainty, but also some initiatives looking at balance sheet, looking at sourcing alternatives to kind of close that gap and improve the outlook in what's a little bit of an uncertain environment.
I'm wondering if at this point in time you look at the potential trade wars that could be looming on the horizon, you look at what's going on with China currently, and you think the risk here is to the downside. And I ask this because I feel like when we were talking to economists, and Steve, correct me if I'm wrong, prior to a lot of the tariffs going into effect, economists were rather conservative in their estimates of the impact on the economy, saying that it would be extremely contained, right, to the actual dollar amount of the tariffs.
If I could just insert for 1 second, yeah. I think the new development here is the global slowdown and the linkage that's now thought to exist between the tariffs and the global slowdown. And I guess you don't put in some of the strongest tariffs since the 1930s without having some global economic effect.
Right. So is really your outlook for growth, are the risks to the downside?
I think there's certainly there. And I think it's not just the direct impact, it's also the indirect impact. So if we take autos, it's about the supply chain, it's about the financing arms, it's about how that flows through in other ways and not just the first order impact, if you would have it. But we're fixed income investors, and when we think about corporates, we still think there's opportunities. Clearly, spreads and yields are wide to kind of capture some of this uncertainty. And we think if you stay short in some of these sectors that are dislocated, there's still some really good opportunities out there.
Sarat, what's your view?
So my view is, I think once we take this trade war off the table, and if you look at kind of direct companies that are affected by this, industrial companies, home building product companies, take a Masco, Fortune Brands, Lowe's, all of them have a really hard time forecasting what their earnings are going to be in the third and fourth quarter. Now, if you take away some of that and you say what my input costs are, that then relates to the consumer, who, when they have some idea of what the costs are going to be, you're going to see some expenditure there that'll actually drive some of the earnings
So there's
growth.
like uncertainty going down the chain.
It is. So it starts with the industrial companies, then it goes to the consumer and says, well, what do I want to do, and where are rates going to be? And I think if you get that with rates kind of staying where they are, and you get industrial production costs coming down, certainty, whether it's a GM, those type of companies can actually then project earnings growth, which they're not going to do now because they're going to be conservative, because we know what happens if you actually overpromise and underdeliver. Your stock just gets killed. You saw that in December, especially with anything cyclical getting priced as if we're going to be in a recession. So companies can be very careful because we know inevitably the slowdown's coming. So where do you want to be in that?
I also wonder the extent to which, even after there's an agreement, if there is one between China and the U.S., you can just put the genie back in the bottle. I'm not sure that's the case if he's disrupted. I do want to ask a question, Sarat. Our last graphic, I never know these crazy people who I survey every 6 weeks when they have a Fed meeting, how much they represent the market. But I forget what the number is. 81% are now say there's going to be an agreement. Is it baked in? Is there any upside to be had once this deal is announced? Does the market breathe a sigh of relief, or is it already?
It's 3% off its record highs.
Yeah, exactly. Is it already there?
So where I would break that down is to see what's going to drive the market. That's going to be earnings, right? It's not going to be the GDP could be 2.2%, but if you get growth in industrials and financials, that's what's going to drive the market. Doesn't necessarily mean the S&P itself might go up 10%, but you can get sectors that have been completely displaced and are trading at 20-30% discounts, i.e. financials.
You're still holding out hope for the financials.
I am, and I think
they've had some of the best, theoretically, a great operating environment last year. They had great earnings last year on a historical basis, but look, yet the stocks have done nothing.
The stocks have done nothing, but look at kind of one of their big growth drivers is loan growth. And loan growth will come back if you've got some confidence in companies to say, I actually know what my input costs are, and perhaps then I know what my demand's going to be. So that's going to be driving some of these companies going forward. And they're trading at, close to book and trading at 10 times earnings. So it's not like you are buying something at peak valuations, you do have some safety there. And
is that your highest conviction sector?
Financials, large cap, regionals, those are the areas that are our highest conviction.
And regionals, I assume there's a M&A component.
Well, part of that, yeah, the BB&Ts, U.S. Bank Corps, and then you got the Bank of America's, J.P. Morgan's.
Hey, Sarat, can I just ask you, we had Peter Bookvar here yesterday, and he said his big concern about what's happening in Europe right now is that the ECB is kind of destroying the financial sector by keeping these incredibly low interest rates for an extended period of time. If you look and kind of follow what our Treasury market's been doing, just with the 10-year below 2.6% again, do you have concerns that to a lesser degree that will also play out in our financial system?
I think one of the legs of growth has been taken away. I mean, you've seen the yield curve pretty much flatten. We're close to inversion over there, too. But I think if you get loan growth back and you get these companies focused on their discipline of cutting costs, which they're doing in a really good way, almost 3% dividend yields across the board. If you get 5 to 7% earnings growth, you're getting a 10% return on a sector that really has done nothing for a couple of years. So that's kind of where I'm looking for the value. I think we're fairly valued in the S&P right now. So a lot of stocks are trading at all-time highs now. We're getting close to that area. So as an investor, where do you want to be in the next couple of years? And where do you really have safety? And that's kind of what we're looking at. Now, recession comes, all bets are off because we know what happens. But you've got well-run companies, cutting costs, good balance sheets, still have deregulation, and you get a potential growth with loan growth that I think could come with trade tariffs kind of coming off.
Janelle, where's the best opportunity right now in fixed income?
Yeah, I think we're seeing the same thing as far as balance sheet growth. I mean, I think we like the lower portion of the investment grade universe, where you can capture some yield, take advantage of where there's still a steep spread curve, even though the rate curve is flat, and still be fairly defensive. I think one of the other things, that we're really focused on. So
emerging market corporates, is that where you are?
We're not heavily
that's
invested
the low end. Tell me how low.
It's interesting. Look, when you think about rates and where we are, and you look at sectors that have been beaten up in the market, emerging market, there's still some recovery and likely some support there.